Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're talking about a financial instrument that most residential buyers have never heard of, and most agents don't know how to use, and most lenders have very little incentive to promote. It's called an assumable mortgage, and in today's rate environment, it might be the most powerful tool sitting unused in the real estate market. So let me set the table. It starts with the rate gap story. Mortgage rates are forecast to hover in the 6 to 6.5 range for a 30-year fixed-rate mortgage through most of this year. That's according to the Mortgage Bankers Association. Meanwhile, about 3/4 of the VA homeowners hold mortgage rates below 5%. That gap between what borrowers locked in 2020 and 2021 and what a new buyer faces today is huge, and it has a dollar value that we can calculate precisely. On a $400,000 loan, the difference between a 7% rate and a 3% rate works out to roughly $974 a month. Over the life of the loan, the interest savings alone can exceed $200,000. Nearly $1,000 a month, $200,000 over the life of the home. That's not a rounding error, that's almost a house. So what is an assumable mortgage? Here are the basics. Only FHA, VA, and USDA mortgages are assumable. Conventional and jumbo loans are not assumable because they contain the due on sale clause, which requires full repayment of the loan when ownership of the property transfers. So when the seller with an FHA or VA loan lists their home, a qualified buyer can step into that existing loan, keep the original rate, the original balance, and the original amortization schedule. You don't originate a new loan at today's rates. You inherit the seller's loan from maybe 2021 at 3.25%. Roughly 31.8% of new mortgages from 2024 can be assumed by future home buyers. That's nearly a third of all mortgages originated 2 years ago. The inventory of assumable loans is not small. Problem is, almost nobody's using them. Mortgage assumptions grew 139% from 2022 to 2023, reaching about only 6,000 assumptions. VA assumptions specifically jumped 62% from 308 in 2022 to about 2,200 in 2023. Now, both FHA and Veterans Administration loans exceeded 5,000 assumptions in 2024. That's a drop in the bucket when you consider that fewer than 6,000 loans were assumed in a year out of 7.8 million outstanding FHA mortgages. We're talking about a utilization rate that's almost insignificant. It's invisible. The demand is there. The supply of assumable loans is huge. So what's the bottleneck? Well, there's 3 friction points. First is the equity gap. When the seller bought their house in 2020 for, say, $350,000, and now it's worth $500,000, the remaining loan balance might be $310,000. The buyer assumes that $310,000 at 3.25%. That's great, but they still need to cover the $190,000 difference between the loan balance and the purchase price. The main challenge with assumable mortgage is bridging the equity gap, the difference between the remaining loan balance and the home's purchase price. You can finance the equity gap sometimes with a second mortgage or a home equity loan. While this loan might carry a higher interest rate than the assumed first mortgage, the blended rate of both loans will still likely be lower than the single new mortgage or current rates. The second friction point is time. Plan for 60 to 90 days from offer acceptance to closing. It's longer than a typical purchase, which averages around 30 to 45 days. In a competitive market, that extended timeline can kill deals before they close. The third friction point are the lenders themselves. Many lenders lack the infrastructure or the incentive to process assumptions quickly. Qualification process can vary widely and it can lack transparency. So think about the incentive from the lender's perspective. Processing an assumption means inheriting a loan that earns 3% rather than originating a brand new loan at 6.5%. Not only that, the lender gets an origination fee, so there's no financial incentive for servicers to make this easy. But here's what's interesting. The Federal Housing Finance Director, Bill Pulte, has signaled that Fannie Mae and Freddie Mac are exploring major changes to conventional mortgage offerings by evaluating assumable and portable loan structures with the goal of making these options available in a safe and sound manner. If conventional loans ever become assumable, the entire calculus of the housing market changes. Now, we're not there yet, but the conversation is happening at the highest level. For now, the opportunity lives exclusively in the FHA domain, in Veterans Administration loans, and in USDA loans. There are currently 42,000 active VA assumable listings with an average assumed rate of about 3.2% versus the current market rate over 6%. One thing most buyers don't realize is you do not need to be a veteran to assume a VA loan. Anyone who meets the lender's credit and income requirements can assume a VA mortgage. So read that again. You do not need to be a vet. Assumable mortgages are not a loophole. They're legal, they're government-backed mechanisms that have existed for decades and work exactly as designed. Based on an analysis of over 300,000 assumable listings, the average buyer saves about almost $1,200 a month or $14,000 a year versus buying at today's rates. In a market where affordability is a defining constraint on a transaction and transaction volume, that's a number worth chasing. The buyers who figure this out will have a meaningful advantage. The agents who master the process will have a compelling reason to be called first. You might not be able to get a great rate on a new loan. You might be able to inherit one. As you think about that, have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.